and welcome to Property Question Time. I'm Bryony Billson and this is the show where you get the chance to have your questions answered by our resident property experts. So, let's see who we have in the hot seat today. A warm welcome to Satyen Lakhani from Off Market Investment. Thank you for coming. Suchit Punnose, founder and CEO of Red Ribbon. Thank you. And last but by no means least, Paul Mahoney, the CEO of Nova Financial Limited. Thank you for giving up your time today, gentlemen. We're going to go straight in with our first question, and this is for you, Satyen. I'm considering buying a new build off-plan resale, i.e. not from the developer, but from someone that purchased the property from the developer and then stuck it on Rightmove. Is this generally considered safe, and what are the associated risks? Any advice on this question?
Oh, that's a loaded question.
It is a bit, isn't it?
I think the key is, in all of these things, you need to be prepared to do research. I say that quite often when I'm in here, but it's so important because once you start that process, you understand where to go and what advice to take. If it's a resale, you need to inquire from the developer really that is it an assignable property? Is it an assignable contract? Because if it's not assignable, then you may be stuck where you have to buy it with cash. Buy assignable allows you to take a mortgage on it. So you need to ascertain some information from the developer. If you can, you want to inquire from that developer, why has it gone to Rightmove or a portal as such? Why has it not gone back to the developer to say, look, we've got a unit that's come back on the market, and you can then try and negotiate perhaps a better price with that developer because they're keen to get that sold. They've sold it once already. They don't really want it back on the market because it spoils their pricing strategy perhaps on the other units that they're trying to sell as well. So you need to make some inquiries with the developer or perhaps companies that are trying to sell on behalf of that developer. And there are many there. And that's what they're there to do. They're there to assist you and help you through the maze of the best way to get to that unit. So you need to inquire from the developer as to why is it on the market again and is it an assignable contract. And this is again where you could ask these questions to your lawyers as well, who can find out for you. Make direct inquiry to the developer or even the developer solicitors. Bear in mind that when you try and purchase from the developer, they will ask you for a reservation fee, and this is usually non-refundable. So you're well within your rights to put money down that you may lose. You want to make sure you've got the right questions answered. And again, having your lawyer do that for you is really the best way, and that lawyer can ask the developer's lawyer. So you'll probably get the best answer from source. If you can use a property company that's associated with it, do that as well. That's a second route to find out. And of course, you then, to assure that you can get finance on it, you need to take advice from a mortgage broker of sort who will assist you and help you through that maze as well. So yes, opportunities are there to try and get the best pricing possible, work with the developer and use people around you who perhaps may know a lot more to assist you. In any of these things, I think the best advice to give to any kind of buyer is surround yourself with people who probably know more than you will, and they'll find out the right answers to help you make the right decisions.
Brilliant. A really thorough response there.
Just expand on that slightly. Exactly right. Even if it is an assignable contract though, there are limitations around mortgages.
Okay.
The vast majority of lenders won't lend on an assigned contract. Some will. It's a very small pool.
Okay.
And even those that will generally only lend at the value that the original buyer paid, not what that subsequent buyer is paying. So, you know, for example, the original buyer pays £100,000 for that one-bedroom apartment, as an example. They're reselling at £120,000. The lender, even if it is an assigned contract, will generally only lend at on the £100,000 value. So that's important to understand as well. You don't want to get yourself into a situation where you can't borrow as much as you're expecting to, or you can't borrow at all.
Fantastic. Thank you. A really thorough response from both of you there, and really helpful. So generally, it's not that it's not safe or not safe, but actually really ask all the right questions and take further advice.
Yeah, and compare the pricing, absolutely, as Paul has said. Your assignable, your resale price may be higher than the price you may get direct from the developer on the other units that are available.
Excellent.
So yeah, compare your pricing there.
So my next question is for Suchit, and this question is in regard to buying in India. I am an NRI and I wish to invest in commercial property, a shop or an office, by forming my own company as an investment holding company in India. The income will be purely rental income. Can I take a loan out from the UK to help me with this?
Good question. Yes, the answer is yes, you can. In this case, the viewer is structuring the investment as a limited company in India which owns the asset. The easiest thing to do is to go to probably a local lender in India, and based on the loan to value and the property profile, you should be able to easily get a commercial loan on the ground in India. If you are getting a loan from the UK, it usually would be on the basis of whatever the credit covenants are of the client and not necessarily on the underlying asset. So it'll be a pure borrowing done on the basis of a personal loan. Cross-border lending is very expensive, so unless it is of a substantial value, it makes perfect sense to borrow locally in India.
Okay, so that would be, your advice would be perhaps to borrow locally in India rather than from the UK and then take it across.
Correct. Yes.
Okay, fantastic. Do either of you two have any experience of?
I suppose just in general, from a finance perspective, again, completely agree. Anything that makes that borrowing more risky to the lender is going to make that borrowing more expensive. So, for a UK lender to lend on an asset overseas, obviously there's much more risk there. And to mitigate that risk, you could just be borrowing from someone who's local. And the same goes, for people investing in the UK that might live overseas, making sure that you're, I suppose, exploring your finance options and getting the most cost-effective options can save you a lot of money.
Thank you. And is that fairly easy to get a loan locally? I mean, is that a relatively straightforward thing to do in India in comparison to in the UK?
Yes, indeed. I mean, as Paul was referring to, for a lender, it's all about risk and risk management. So the lender would look at the quality of the building, what are the chances of a good rental yield, and they'll do their standard calculations and come up with a loan-to-value ratio. And so long as the client has got a good, clean credit history locally in India, they do tend to check the client's credit history in the UK as well. The lenders have started doing that. Brilliant. So long as all of those boxes are ticked, it's a fairly straightforward process.
So the next question goes to you, Paul. Quite a big question. They've asked, keep or sell? We refurbished our current home with a lot of love and attention to detail, as a lot of people do. However, it's now too small for our family. We've been thinking of moving for a long time, but the idea of selling this house is breaking our hearts. Moreover, this house has a lot of potential, loft conversion or a conversion into 2 flats, and they say a couple of properties in the neighbourhood have done this. It's also a lovely area with good schools and great links to London, and it's in Zone 4. If we rent it out for a few years as it is, we could get a rent of about $1,800 per calendar month. This is more than enough to pay the mortgage. So, I mean, there's quite a lot going on, quite a lot of detail, and I definitely can relate with the adding the emotional element into doing up a house and living there. But what would your advice be in this kind of keep or sell scenario, particularly, with the financial side that they've mentioned?
There's a few points to that question. I suppose the first point is remove the emotion. I know that's a difficult thing, and that's very easy for me to say and not very easy for somebody to do, but definitely try as much as possible to remove the emotion and be commercially minded when it comes to something like this.
Okay.
Because at the end of the day, if you're renting it out, it's not really yours anymore. You're not getting the utility of it. You're letting somebody else use it and occupy it. So try to remove that as much as possible. In saying that, though, I am always reticent to telling people to sell property because it's a long-term thing. And so long as that, I don't know anything about the property really, aside from the fact it's in Zone 4 and it'll rent for £1,800 a month. But if it is a good investment, then maybe it is worth keeping. They'd obviously need to assess, that for a start. Maybe they could seek advice on that or do some of their own research to determine whether that is a good investment, because obviously they've bought it as a home, and the criteria that goes into buying a home is very different to the criteria that goes into buying an investment. Mm-hmm. A home, you need to love the place. It needs to be your home. Whereas an investment should be about the numbers and the fundamentals. So assess that, I suppose, to start with. They would then need to assess their ability for finance, because just because the rent would be enough to cover the mortgage doesn't mean they'd be able to actually get the mortgage they need, because given some recent changes in the market, there are higher stress testing levels than what lenders are actually lending at. So that would be another thing to assess. Is finance actually viable? Especially because the property's in London. London properties in general, the yields are quite low, on average about 3.5% to 4%, which can make it difficult to borrow what you might think you could be able to borrow, or what you could have borrowed last year, for example, before these changes. So there's a few things to consider there. I'd certainly explore their options as far as keeping the property rather than rushing into selling it. And that should put them in a more informed position as to whether that's the best option for them or not.
Okay, fantastic. Brilliant response to that question there, because there's so much going on. And so am I right in thinking that this person really needs to make sure that they're seeking the correct advice, because while they might think they can cover their mortgage, given the changes that we've seen in the last year, that might not really be the case.
Exactly, and some of that depends on their ability for finance. Another part of it will depend on their actual personal tax position. With Section 24, I won't go into all the changes, but with Section 24 and the way that affects the way mortgage interests will be tax deductible on buy-to-let mortgages, that's another consideration. Will this property actually wash its face after all these changes? Are all very important things for them to understand, and that most people in general wouldn't understand, on the face of it. So therefore, seeking advice would be pretty important in their situation.
Thank you. I think that's really good to keep in mind, that actually it's quite normal to feel confused about these types of things.
I think Paul mentioned a key point there. As soon as you bring investment into a discussion, you've got to take the emotion out. Because by right, investment is all about a box that gives you a return. And once you bring emotion into that, you can't see the focus as to what you're trying to do. So it's very important. I mean, it's a great question by that viewer, but they've got to be as strong to remove the emotion away. Then you can work out your figures properly and seek the right advice that you need. So investment and emotion, two things can't go together, in my opinion.
No, absolutely. I think that's brilliant advice. Thank you. Okay, we're going to take a short break there, but please stay with us. After break, we'll be hearing more from our property experts, and they'll be sharing some of their top tips and golden nuggets. We'll see you soon. Hello and welcome back to Property Question Time. I'm Bryony Billson and we are with our expert panellists today. Warm welcome again to Satyen Lakhani, Suchit Punnose and Paul Mahoney. And we're going to go straight to you, Paul, for one of your golden nuggets.
Yes. So my golden nugget is, when it comes to investing in property, to know your limitations or know your skill set, I suppose. Something I've seen a lot in the market lately is seminars, books, talks about property development, commercial to residential conversions, all sorts of quite hands-on, skill-based property investment. And my analogy for this is, you don't do a week's course and then become a brain surgeon, And property development, and that might be a bit silly, but property development is a profession. It's something that people do for years and years and years for someone else, learning how to do it, learning how they can actually make money out of it, because that's, at the end of the day, that's why we invest, to make money. So if you're a first-time investor, or even someone who's only been in the industry for a few years, going out and buying a block to redevelop on your own, or even with some people around you, probably isn't the best idea. You need to build up to that type of thing. So I'd say, when it comes to being a first-time investor or building your skill set, start relatively passively, and build your way up in complexity toward being a bit more creative and toward maybe making more money. But at the end of the day, property developments or redevelopment projects don't always make more money than passive investments either. So just understanding that when it comes to investing, or when it comes to property development, it's not as easy as you might see on the TV, or as you might be told in those one-day seminars where you can double your money overnight. If it's too good to be true, it usually is. So making sure that you start based upon where you're actually at with regards to your knowledge and your skill set.
Why do you think people do this, Paul? I mean, that was an excellent piece of advice there, but I agree. I think people do this a lot of the time. Is it because it can be such an exciting thing to do that people throw themselves into it, or then
Yeah,
they go
look,
to a
of course
course
it's
and set
exciting.
them up.
You know, being told that you can make £100,000 in a month without any money down, well, you know, isn't that brilliant? But, you know, in reality, that's pie in the sky stuff. You know, keeping your feet on the ground when it comes to investing is very, very important, because it makes sense as to why all these guys are running these courses and things. I'm sure they're making lots of money out of them. But making sure that you understand what's real and what's not, and, you know, do what's right for you and what's right for your sort of skill level and also your risk profile.
Okay, fantastic. Fantastic piece of advice. Don't bite off more than you can chew.
Yeah.
Excellent. Okay, let's go back to our questions, and I'm going to go to you, Satyen. Our next question from our viewer says, I'm looking to buy a property off plan. At present, the single property site has been cleared, but no works have been started on the build. I have had my house valued, but it's not on the market yet. Do you think the builder would accept an offer, as I'm not in a position to move? The house won't be available for 6 to 9 months, so it would give me, hopefully, plenty of time to sell mine. Quite a lot going on in that question. Any advice there?
I think, again, timing is key.
Okay.
So you don't want to put yourself out of position, really, if you can't guarantee your own timing.
Right.
So what I mean by that is that if you want to put an offer on a property to the developer and you want them to accept it, you need to put yourself in the best position you can. If you're not on the market and you feel there's enough time to sell yours, then get it on the market now. Get yourself in a position where you have more control than the developer. Then you're more likely to get them to accept a better price for the property you want to buy. And again, key factors here is who's looking after your property, who's looking after the property you want from that developer. What are they saying to you? And as Paul's put it through that golden nugget, which I thought was an excellent golden nugget, do your research. Because anything you want, you can find in the public domain as to why do you want to buy that unit that's off plan, what are your reasons, and do your reasons justify what you're trying to do by selling your property or not selling it or not put it on the market yet. Are you trying to wait to capitalize on the money you might get in 6 months as opposed to now? So again, be careful, because if you're trying to be too greedy on both ends, trying to get your price on that new property as low as possible and maximize the price on your one, with any kind of, if you like, trying to get the returns there, there's always a risk that you may lose on both ends. So put yourself in the best position you can, get it valued, make sure that whoever's valued that property can stack it up in 6 months' time. Do your research on why you're buying in that area. What will happen to that price you get agreed today in 6 months' time? Justify what you want to do and why and what your motives are. And that way, you've tick box, I call it. When we look at any developments, we look at tick boxes. And we have a range from the years that have been doing this, 87 tick boxes. And if we can tick 80 out of those 87, we're comfortable that that's a good area to invest in. And the viewer should do the same as well. Because the more you find out for yourself, the less you need to go somewhere else to ask, because you've got that information yourself. And if it's in the public domain, that means anyone can see that this is correct. You're not just relying on a third party telling you because they're telling you. As long as you can justify it, make the right decisions based on that. So logic, system, and follow what you feel properly. Go through with it full on. If you do it half-heartedly, chances are you're going to make a wrong decision and you'll fall flat on your face. And we don't want anyone to go through that positioning, absolutely not.
No, brilliant, fantastic. An excellent response there to that question. Lots of really clear detail, so really consider your timing, be much more kind of strategic and logical about your decisions there.
Again, key factor, once you negotiate the price with the developer, he'll want a reservation fee, which would be non-refundable. So are you prepared to put money down that you might lose based on something that might or might not happen with your own house? Again, that's where the risk-reward comes into it.
Okay, fantastic. Really, really brilliant advice there. And I like the idea of having a checklist and kind of thinking about the questions that you'd want to ask. I'm sure you have advice on that area as well, but we do need to move on to our next question, if that's okay with you. And this question is to you, Suchit. And this straightforward question: what is the process of purchasing a property in India? Any tips for buying property, such as a checklist or items to verify? So actually similar, getting a checklist, but quite specific with this one about buying in India. Any advice there?
Yes, indeed. I think the difference in buying a property in India is that one doesn't go through lawyers for conveyancing as one does here in the UK. So you would apply the same common sense approach that both my colleagues have spoken about. Research is key. India is a big country, so the idea would be to look for cities that can give a maximum capital growth, but you would go down and have the simple common sense approach to look at who the developer is, what's the track record of the developer, is it in an area where you can rent the property, and the process is very simple. If it's new build, you wire the money to the developer and they write in a title in your name, and it's as simple as that. If it is not a new build, if it's a pre-built old property, then the due diligence needs to be a lot more to ensure that the person who's selling is indeed the owner. Title deeds in India have over the years gone online, so it's easier to check and verify the ownership or the title of a property. But one would approach it just the same way as one would here in the UK. Look for good location, good developer, and if it's rentable and if it's value for money.
Fantastic. So really positive response to that question, actually, that really a lot of the things still, it's the same systems
Indeed,
apply.
yes.
So
Yeah.
if they've invested in property in the UK and they've got a checklist for that, they could apply that to buying in India.
Indeed, yes.
Fantastic. Okay, excellent. Well, we're going to move on to our next question to Paul. Not such a long one this time for you, Paul, but equally confusing for some people. I need to remortgage my current main house. I do own 2 more houses which are mortgage-free and are rented out privately. What questions are the mortgage lenders likely to ask? And is it better going through a broker in cases like this, for example, face-to-face?
Okay, very broad question.
Yeah.
Remortgaging their home, they've got 2 buy-to-lets. What questions are lenders likely to ask? They're likely to ask quite a few. They're going to want to know all about that individual's personal financial position. So their employment, their income is very important when it comes to a residential mortgage, because that is the main serviceability for that mortgage. Some lenders will consider the rent from the buy-to-lets, others won't. So not knowing this person's situation, if they're not employed, then that would limit their mortgage options. But it wouldn't necessarily rule them out, given they're getting rent from the buy-to-lets.
Okay.
They would also want to know things like, have they ever had any credit issues in the past? Do they have any other debt obligations, credit cards, car loans, whatever it might be? Their overall financial strength, really, both from an asset and a sort of serviceability or liquidity perspective. How are they going to service this mortgage? Also, I suppose what they're looking to use the money for. I don't think they've mentioned whether they currently have a mortgage on their home. No. If they do and they're just remortgaging to get a better rate or something, then fine. If it's debt-free, like their buy-to-lets, well, why do they need the money? Some lenders will want to know that. Some don't really mind, so long as it's not for things like gambling or debt consolidation or whatever it might be. But there's a lot that goes into it. That kind of ties into the second half of the question as to why it most definitely does make sense to get advice. That advice doesn't have to be face-to-face. Mortgage advisors can advise via correspondence almost as well as face-to-face. I'd say the only reason to do face-to-face is you actually get to know the person, which I think in business is always a good idea. But seeking advice just gives you a much broader spread of the market. A lot of people, when it comes to getting mortgages or getting mortgage advice, will just go to their bank, and their bank will only have a certain criteria. Now, often that bank might say, well, no, you don't fit our criteria, and then they'll make the determination, well, I can't get a mortgage, which isn't really the case. There's a very, very broad range of lenders out there with a very broad range of criteria. And understanding that as an individual is very, very difficult. And in fact, some mortgage products are only available to intermediaries or brokers, and they're not available directly to the public. So by seeking advice, the right advice, you can get a much more broad understanding of what's available to you, and then hopefully, through that advice, end up with the best possible product or the right outcome for you.
Fantastic. Brilliant, Paul. Thank you. And I think, you know, getting that right advice when someone in this situation seems like they do have quite a number of options available to them, that does seem to be very important. So thank you for your advice on that one. I'm sure they'll really appreciate it. Well, I'm afraid that's all we've got time for today, gentlemen. Thank you so much for your fantastic answers to some quite complex questions in this week. So I really appreciate your time and advice with that. And if you have a question that you want answered, you can email us at info@propertytelevision.tv, or you can go to our website, which is property-tv.co.uk, or why not download our app and join us there.